All right. Well, it's the top of the hour. People are still going to be rolling in, and that's okay. But I think we want to get started here since we've got a 30-minute window to present to you guys. So without further ado, I'll just kind of introduce myself and introduce all the other guest speakers we've got on the call as well. So I'll kick things off. My name is Chris Ferry. Some of you guys may have seen some emails from me inviting you to this or other events, but I am the client concierge over here at Atlas. So some of my responsibilities include helping our investors do a deep dive into their portfolios through setting up a portfolio evaluation with my team. And then the other big responsibility I have is helping educate our residents on the power of home buying so that they too can one day hopefully become investors like many of us on this call. So some of our guest speakers today, first one up is going to be Eric Thorson. He's our VP of Institutional SFR. He has over 14 years of experience in real estate acquisition and development. He's participated in over 2 billion, and that's billion with a B, 2 billion single family transactions across the nation. And here at Atlas, he helps lead the acquisition and asset management team. Next up on the call, you guys will get to hear from Brian Ballou. Brian leads Atlas's property management team, and he also oversees all of AHS. He has a background as a broker as well, with Zillow Offers doing over $150 million in real estate transactions. So no big deal there. And then we're just so excited. This next guy doesn't need any introduction, but he is a man who has just flown back in from Mexico to be with us on the call today. It's our very own CEO, Tony Julianelle. So we're super glad he could make it. And then last up, but certainly not least, we have our special guest for today is Chris Nebenzahl. Chris, he's from the John Burns Research and Consulting. That's the same company that puts out the famous Burns Report. So some of you may be familiar with that. But Chris leads the apartment, build to rent, and SFR products, as well as helps develop the company's research and public presence across various verticals and platforms. He's highly educated. He's a local to Denver here, like a lot of us on this call, and we're pumped to have him. So Chris, welcome to the call and take it away. Can't wait to hear what you got.
Thanks very much, Chris, and I'm excited to be here. Thanks for the opportunity. As Chris mentioned, I lead the BTR apartment and SFR verticals at John Burns, but I'm more excited today to talk to you. As Chris mentioned, I'm a local here in Denver, and I'm also a real estate owner. I have a couple of units of my own that I manage and invest on the side, and so it's great to talk to a group like you. I'm gonna cover kind of the entire rental market from institutional grade multifamily down to scattered site SFR, and I'm gonna cover things at a pretty high level at the national level, and then we'll drill into some of the markets that the Atlas team had recommended that you all might be interested in. Chris will be distributing the slides afterward. I know we've got a lot to talk about, so no worries there. You all will get a copy of the slides, and please, throw questions in the chat. I think Chris is going to monitor the chat as we're going, and I know Brian and Eric also have questions that we'll be going through as well. But diving right in, so where are we from kind of a multifamily, a rental perspective? 2024 was a really, really good year for demand. If not for the generational supply that we saw, we didn't see as many deliveries last year as we have since the mid 80s. So it's really been 50 years since we saw peak deliveries like we saw last year, but the demand was really, really good. Absorption was very, very strong, especially in Sunbelt markets. And it's interesting to hear me say that perhaps because the Sunbelt is where we're seeing the weakest rent growth. They saw the most supply. They also saw the most demand. So the Sunbelt is in a bit of this period of, I'd say, mixed fundamentals or extreme fundamentals, tons of supply, but also tons of demand. And with that, there's a lot of interest in development. But here in 2025 and in 2024 as well, few projects are actually getting started. Interest rates are up. I don't need to tell you all that. The environment is challenging. Rent growth has been hard to come by, not only in multifamily, but in BTR and SFR as well. So we're just kind of going, I'd say, moving through a tough time, some choppy waters to understand kind of where we're at in 2025. Similar on the transaction side of things for multifamily and single family, price discovery is still happening. We're still kind of searching for a bottom for things like cap rates, things like prices per unit. And so I would expect we'll see transaction volume fairly modest this year, again, on the single family side as well as multifamily. There was just a stat that came out today. New home sales are down. We're continuing to see existing home sales are low, and multifamily transaction activity is pretty soft as well. But on the good news front, BTR is really the favorite asset class. A lot of multifamily operators want to get into BTR. A lot of single family operators want to get into BTR. And it's really this blend, this hybrid, this mix between multifamily and single family that the BTR sector is filling that gap. So there's a lot of interest in BTR. Moving forward, again, a little bit of a highlight of what the REIT said recently. Um, it's really a tale of two geographies. The Sun Belt is struggling from a fundamental perspective. Rents are down, occupancy's soft. The coast, the Northeast, the Midwest, doing much better. They haven't quite had the same amount of supply, but their demand has met the supply. So you see fundamental performance a little bit stronger. Again, there's interest in development, but it's hard to get the deals penciled. And again, you'll see this from the home builders. You'll see this from the multifamily folks, the single family folks. I just want to read this quote from UDR, and I thought that was really telling for where the entire market is. And Joseph Fisher, their CFO, said, "I think the ability to translate excitement and a thesis on the future into actual shovels in the ground is a little bit more challenging. That thesis is we want to develop more, we want to build more. So if you have the thesis, yes, great. I think a lot of us believe in it, want to build more, but do you have the capital? Not so much." So we're seeing this shift. And really, if you go back 2 or 3 years, everyone was building. The home builders were building single family, the multifamily developers were building multifamily, BTR developers were very active. That's really ground to a halt. And that's good news for fundamentals, good news for rent growth emerging, good news for occupancy, because there is still demand. Remember, I was talking about how demand was elevated. And if not for all that supply, demand would have been the story last year. I don't expect the demand to fall. Really, I don't expect it to fall nearly as much as supply. So I do expect the supply and demand for all types of rentals to come back more in balance this year and certainly next year and beyond, perhaps even favoring the owners, the operators on the demand side in 26 and 27. Touching briefly on AMH, they just reported their earnings. New lease growth is flat, decelerated from prior quarters. That's interesting because the SFR market has been a lot steadier than BTR and multifamily. BTR and multifamily rents have been negative. The fact that new leases are now flat and decelerating, that gives me a little pause, and that tells me that there's more supply on the SFR side as well. And we'll talk about the different forms of SFR supply in a minute, but it's coming from resale listings accelerating. It's coming from some of the home builders selling their units to SFR operators. So some slight headwinds on the SFR side as well. Again, SFRs tends to be a little steadier than BTR and multifamily, but the fact that they're slowing down gives me a little pause as we move into 2025. But they're still expecting about 3% rent growth in line with what our forecasts are as well. So overall, we're in a pretty good place as a rental sector in general.
Hey, Chris, one question around this. Are
Yeah.
you seeing new lease rental growth being actually less than renewal rent growth, which is kind of a flip from its historical norm?
Yes, definitely in the multifamily side and the BTR side, we've seen new lease growth actually fall negative in a lot of markets, especially in the Sun Belt. We're going to talk about Phoenix. We're going to talk about Denver. Those are two markets where new lease rent growth has fallen. Now, renewals, we are still seeing either flat or modestly growing rents on the renewal side. So that's kind of helping balance things out. On the SFR side, they're about flat. Or I'd say they're about equal. I shouldn't say they're flat. We're still seeing growth on the new lease side of SFR, but that's decelerating as well. And the renewal side is about the same in that kind of 3 to 4% range.
Yeah, just shows how important it is to keep a resident in place.
Absolutely. And you don't have to worry about turn costs. You don't have to worry about vacancy loss. We're actually seeing and hearing a lot from the big apartment REITs as well. The multifamily industry, they're often comfortable with some turnover, but given the fact that new leases are below renewals, they want to keep those residents happy and keep them in place. So moving forward, I did show the definitions of census and JBREC, how we define BTR. They're a little bit different, and you'll see in these next couple slides what's going on in BTR supply. As the census defines it, you see a rapid acceleration in build to rent supply. That's homes that are built to rent. That could be in BTR communities, the way John Burns defines it, but it also could be scattered site. It also could be ADUs. It also could be some student housing, some senior housing. So you'll see as we go forward a little bit of the divergence in the starts activity. Again, you see census starts growing quite quickly. Where are they growing? In the homes that are built for rent, it's mostly in the South. You can see going back to 2000, things stayed pretty steady by the census regions, but really in the past 3 to 4 years, in the South and a little bit in the West, this is Phoenix. This is parts of California as well, where there's been a lot more ADU development. That green line, that's the West, that's increased a little bit, but the South is really where you see the meteoric growth in the starts activity. And that's Florida, the Carolinas, Texas, really where you've seen a lot of the uptick and really where the markets are struggling the most from a rent and an occupancy perspective. Now, interestingly enough, we at John Burns, we see the BTR starts coming down. So this blue line here is what we're reporting in our data. The green line is from census. And again, a couple things I'll note here. The census data tends to lag a little bit. So I do expect that green line to come down a little bit. That will help operators, that will help existing owners who might be struggling with new supply. But we've seen BTR starts drop about 60% in 2024. We're calling for starts to fall another 10, maybe 15% this year. So the supply side of things is definitely coming down. Where is that gap represented? Well, that could be some of the scattered site, the individual one-off homes. So I don't want to say that there's no competition. The census data is representative of some of the activity and some of the development that's coming on. So we need to be aware of it. We call this shadow inventory that's impacting BTR, certainly impacting SFR as well. So there is some inventory hitting the market that's keeping rent growth a little bit weaker than we've seen in previous years, keeping occupancy a little bit softer. But the good news is that we do expect those starts to continue to fall. And over time, as the supply is absorbed, we expect to get back to a much more balanced level. This is from some of our recent survey work that we've done with some of the biggest build-to-rent operators, and they only saw a 10% decline in build-to-rent starts last year. So John Burns as a whole saw a 60% decline. The largest developers only saw a 10% decline. What that tells me is those who are well capitalized, those that have the best ability to purchase land, to get projects started, they're still doing development. Now it is negative from 23 to 24, but not nearly as negative as the entire industry. And again, you see JP Morgan, they just entered into a joint venture with Georgia Capital. There are a lot of institutions that still want to be in BTR, still want to be in the SFR side, still want to be in multifamily, but BTR is emerging as this really sought after asset class. I mentioned some of that shadow inventory. And what we've started to realize, especially in 2023, late 2023 and 2024, is that a number of the home builders are starting to spin off units for rent. And they're spinning it off to small operators, sometimes large operators, to the tune of about 24,000 homes last year. Oftentimes it's at the end of a month, end of a quarter, they've got inventory on their books and they say, I just want to sell these. Here, Mr. and Mrs. SFR operator will give you 10 homes, we'll give you 30 homes. This we collect in our data. It's not in our BTR data, but it is in our SFR data, and it's a growing percentage. So again, this adds to that shadow inventory, adds to the competition for SFR operators and BTR operators. And where is it happening the most? You see Florida, the Southeast, some of these same regions and same markets that are hit so hard with supply on the BTR and SFR side, they're getting even more homes added to the inventory from the home builders who had initially intended to sell those as one-off homes. They're now selling them to SFR operators. So definitely something that we're keeping our eye on. It is a bit of a headwind for market performance, especially in the Southeast and Florida, but it's happening really across the board as well. Nationwide, it's up to 3.5% compared to 2% in previous years.
Hey, Chris, can I double click on that last slide? I'm
Sure.
curious where you expect that trend to continue, and if you have any predictions for the coming years, because this is a fascinating kind of emerging trend here that seems like may only continue in the future as home builders find more synergies with BTR and SFR operators.
Yeah, and I think it will. I think it will. The home builders development has come down a little bit on the home building front, not nearly as much as what we've seen on the BTR and multifamily front. And the home builders can be a little bit more nimble. They can build when there's demand and they can slow things down. But I would expect that this continues, especially when there's an appetite for SFR and BTR acquisitions. I would expect, the big home builders to continue to move product to those SFR operators.
Right.
So drilling a little bit into the fundamental performance, this is rent growth across apartments, BTR and SFR. Again, you see that big run up in 2021. Apartments and BTR was doing so well, but you also see the big drop off as supply has greatly impacted BTR and apartment rents. You see in 2023, 2024, BTR apartment rents were basically flat, negative in some instances. SFR has been much steadier, very strong in 2021, 7.5% growth, but not as much as BTR and apartments. They also haven't fallen as far as the BTR apartments. So the SFR market continues to be kind of that steady Eddie market, continuing to see rent growth there. Looking at the regions, again, the Midwest, the best region for sure. Places like Chicago, Columbus, Cincinnati, really strong rent growth. The Southwest, Phoenix, we're going to talk about Phoenix in just a bit. Colorado is in there as well. We continue to see negative both new leases and renewal leases on the BTR front. SFR is doing a little bit better, but the BTR front, because we've seen so much supply in these markets, rents have gone negative.
Chris, are you seeing migration trends to the Midwest trend up? I mean, it seems like most of the net migration is happening in the Southeast and the Sun Belt, so that one was a little bit surprising.
Yeah, that's a great question, Brian, and that really gets to kind of the extremes of supply and demand. The migration trends are definitely continue to move towards the Southeast. We've seen some modest migration in the Midwest, but I'd say it's really inter-Midwest migration. Indianapolis, Columbus, Minneapolis have seen decent in-migration, but they're mostly moving from other pockets of the Midwest. The Sun Belt continues to see the vast majority of in-migration. What's going on in the Midwest is that their supply and demand is just much more balanced. They're not getting as much supply, so the existing demand is really balanced and meeting, the existing demand, I should say, is balanced and meeting what we're seeing in terms of supply. And that's why you see performance outpacing the other markets.
Got it. So maybe more of a short-term trend than a long-term trend.
Exactly. And if I were, looking long term, I'd say a lot of these Sunbelt markets pose some really good opportunities because when the supply pipeline ends, and we can see it, the supply is coming to an end fairly soon here. As we saw, starts down 60%, 10%, depending on who you look at. The supply is definitely slowing. The demand is going to be there from a job perspective, migration perspective. And so, yeah, I think long-term, those Sunbelt markets will remain in pretty good demand.
Got it. Thank you.
Looking at a little bit of the product type, these are our 4 BTR product types. The point I want to make here is that, again, BTR seems to be this glue between SFR and multifamily. And I've highlighted the horizontal apartments. This is a product type that looks and feels very similar to a garden style multifamily deal, but it's a BTR product type. When multifamily was doing well and supply was low, horizontal apartments had the highest occupancy. Now, as we've seen a lot of BTR stock added, we've seen a lot of multifamily stock added, their occupancy has dipped. The row homes, the single family detached properties have done much better. Single family detached being much closer to SFR, that's where we've seen the SFR strength really emerge beyond what's going on in BTR and apartments. But I will say SFR is not immune to inventory increases. We talked about the builders selling off some of their inventory to SFR. We've talked about increase in resale home listings that are moving to SFR. And as you see that inventory pick up 2023, 2024, you've seen occupancy start to fall. Now, it's not catastrophic in SFR, but we are starting to see this trend that we'll keep an eye on. Really in the past year or so, SFR occupancy has softened a little bit in line with what some of the REITs, what AMH was saying, their lease growth is starting to decelerate as well. These are our SFR forecasts, and I don't want to drill in on any one market, but I do want to show these kind of regions. Again, Brian, to your point, the migration is all down in the Southeast, but there's so much supply being added that we expect rents to actually fall in a number of the Texas markets, Florida markets. Then you get kind of this in-between space, this middle sliver, that's Denver, that's Kansas City, Colorado Springs, down through the Carolinas. And I'd say there's decent rent growth, kind of flat, not huge growth, but also not huge negative or not huge losses on the rent side. And you see above that, the Northeast and Midwest, things doing really, really well. So those are kind of like the three regions that we've seen in the country and how the SFR story is going to take shape over the next couple of months. Again, just touching on our forecasts, multifamily permits, we expect to be down about 10%. Rent growth in multifamily is going to be back positive, but is not going to be huge. Going to accelerate in those outer years as supply comes down. Same with BTR. I expect a pretty soft year in 2025, but much faster growth in 26, 27, 28 on the rent side for BTR. And so one thing that I do want to stress on more of the finance and fundamental side, why do we expect starts to stay as low as they are? And it's really because interest rates continue to be elevated. Even 4 or 5 months ago, the forward SOFR curve, which is really what a lot of construction loans are tied to, we were expecting to see rates come down about 100 to 150 basis points. Now we're expecting one rate cut this year. If we only get one rate cut, that's going to make deals a lot harder to pencil. We've got a lot of challenges, both from the interest rate market, the fundamental market that we talked about. Rents are still a little bit soft, not going to bounce back for a couple of years. And then construction materials, construction labor, and how that gets impacted by tariff and immigration policy. Those are more headwinds that could lead to lesser development. So the good news on the operator side, fewer starts, less deliveries, less competition. If you're on the developer side of the equation, it's going to be a tough go to get deals started and get deals penciled. Brian, you talked a little bit about affordability in some of our past conversations. I do want to touch on demand for BTR and for SFR. This speaks exactly to what you were talking about, right? Why is BTR still in demand if we have so much supply? Well, it's still significantly more affordable, especially in Texas, especially in Denver, especially in Phoenix and California. It's more affordable to rent a BTR property than to buy a comparable single-family home. Interest rates are still very high. That's going to make housing affordability continually challenged, and I don't see those rates coming down anytime soon. So that's going to be a barrier to entry for a lot of home buyers, keeping them in the rental market, keeping them in SFR and BTR a little bit longer. Again, we're also seeing demand in people moving out of their parents' homes. Household formation continues to be very strong. And even though immigration will slow down, and that was a driver for rental demand, I do expect rental household formation to continue to accelerate as we've got a strong economy, we've got strong job growth, and to the point we just made, it's so unaffordable to buy a home that the rental market will benefit as a result of that. Just finally, I did want to touch briefly on the expense side of things, especially insurance. Many of us have been hit pretty hard with insurance, either on our own homes or on our investment properties. Florida and California get the headlines with the hurricanes and the fires, but look at the maps where on the left, the pink is the darkest: Wyoming, Colorado, Oklahoma, North Texas. Those other coastal states get the headlines, but the volume of claims coming from wind, hail, water damage, really kind of along the mountain region, the Front Range here, and into the lower Midwest and Texas. I expect to see more challenges from the insurance market, and it's going to be a tough situation to navigate through as we continue to see insurance premiums increase. So with that, I'll start to do a deep dive into a few of the markets. But Brian, Chris, any questions that have come in thus far? Anything we want to double click on before we dive into the market fundamentals?
Chris, I don't see anything in the chat there. Do you have something?
No, yeah, chat's quiet. Chat's quiet.
Okay, awesome. So looking at Denver from a single family permitting perspective, this data goes back to the end of last year. It looks pretty flat. Permits are coming down a little bit in single family. For our forecasts, we expect it to be pretty flat in the next couple of years. But look what's going on in multifamily. And this is apartments, this is BTR. We've seen a tremendous slowdown from where we were 2-3 years ago. And this is good news. Again, we talked a lot about supply, the oversupply in places like Denver, places like Phoenix. So the fact that these permit numbers that corresponds with start numbers are coming down, this is good news for the rental community as we look towards the end of this year when these starts and permits deliver into next year, into 2027 and beyond. We start to see improvements in the fundamentals, and we expect to see increasing rent growth, increasing occupancy as well. Again, looking at our build to rent index and our rent growth, again, things dipped negative, but we're starting to see some modest growth. We're not going to get back to 2021 levels. That for us to get back there, we would need another once in a generation, once in a lifetime shift like we saw in COVID. But the good news is that we will start to see continued demand, continued rent growth, or I should say reaccelerating rent growth in places like Denver. Again, on the occupancy side for BTR, it'll stay below the national average, below the top BTR markets until we absorb that supply. But I expect occupancy will tick up again. And again, why do I see that? It's really this chart on the bottom left here, this delta, this difference between the entry-level home payment and where we are for build to rent. And it's in a market like Denver, it's probably going to stay somewhere between $1,000 and $1,500, continuing to drive people into SFR, into BTR. I see continued strength for that sector here. Looking at Phoenix, again, pretty similar story, pretty flat growth in the single family permits going forward into next year. I expect single family permits to be pretty steady in Phoenix. There's still demand in Phoenix. Brian, to your point, where are people moving? Well, they're still moving to Phoenix. They're still moving to the Sun Belt. But on the multifamily side, again, where there's been so much pressure in the apartment space, in the BTR space, those numbers are finally coming down. And again, that's good news for demand. That's good news for overall performance in multifamily and in BTR as well. Again, similar trend you saw in Denver. This one's a little bit more extreme. You saw rent growth in BTR accelerate beyond 20% year over year in 21, dipped all the way negative to about negative 5%. We're starting to emerge. We're starting to see some positive momentum, and we should be back to positive rent growth territory in Phoenix later this year and into next year. Again, why do we see that? That same delta that we talked about in Denver, certainly present in the Phoenix market between owning a home, buying an entry-level home, and renting that BTR property. And then finally, Kansas City. Kansas City fits into that Midwest category that I was talking about. Really strong fundamentals right now, steady growth, not a ton of in-migration, but measured supply and balanced supply. And if you look at the single family side, permits are actually continuing to rise, whereas they were kind of flatlining in Phoenix and in Denver. Same thing with multifamily. So multifamily development permits were really, really low in Kansas City compared to how high they were in Phoenix, how high they were in Denver. We could look at Austin, we could look at Charlotte, we could look at Raleigh, Atlanta, same trend. In the Midwest, the permitting activity has been a lot slower, a lot lower, and so they can absorb and handle an increasing amount of permitting activity that's taking place right now. Same thing, I expect the multifamily and BTR permits to increase in Kansas City. And as a result, you might see some softness. But again, I would look at Kansas City and more of the Midwestern markets as balanced rather than weakness or softness. Things may slow down a little bit compared to where they are today. But again, I see those markets as much more balanced. And if you look at our rent growth projections, still positive rent growth for BTR, still decent occupancy, Kansas City slightly outpacing the national average compared to Phoenix and Denver that were trailing the national average. Again, when I talk about balance, same thing here, much less of a delta in terms of home purchases and BTR, but that speaks to more of a balanced market in places like Kansas City and other Midwestern markets. So with that, I think we're right at about time. We may have gone over just a few minutes, but I'm happy to stay on, answer any questions. Brian, Tony, Eric, or anyone who's on the call, happy to stick around and answer some questions.
Chris, this is great stuff, man. Thank you so much for making the time for us. And we are at time, but I'd love to hang around if anybody else wants to hang around, and we'll take some Q&A.
So I think we did get one question. So the question is on my end. Looks like the chat function is turned off. Oh, well, it's a good, valid question. I think the Q&A is where you can ask the questions. So if you guys, the chat may not be functional, but
I think I can read. There's one chat that came in. I think it says, currently, what offers the best opportunities for residential investment from a climate resilience perspective, low insurance costs, low utility expenses, and minimal natural disaster risk, while also showing strong term economic and population growth?
Yeah, that's a great question. That's like the $1 million question that everyone's asking around the insurance topic, right? What we've seen, the Northeast and Midwest, some of those better performing markets in today's market are actually I would say that they've seen the least increases in insurance premiums. We talked about California, we talked about the coastal states, we talked about where we are here in Denver and some of the lower Midwest. Those insurance premiums are rising the fastest, and we've also had challenges with supply and fundamentals. So the moment right now is definitely taking place in the Midwest, parts of the Northeast, Boston, Providence, Hartford, down towards DC are doing well and don't have the climate risks that some of the other markets, especially the southern coastal markets, and then again, the Texas and Oklahoma markets are facing as well. You also mentioned demand dynamics. Those markets, we continue to see outmigration, but interestingly enough, and I'm thinking, 10, 20, 30 years from now, we might actually see a reversal of the migration trends. We might see a reversal towards places like Chicago and Indianapolis and the Ohio markets, Pennsylvania, if the trends that we've seen recently in insurance costs continue. And there was a lot of talk about insurance companies leaving the state of California entirely as a result of the wildfires. I'm not an insurance expert. I don't know exactly what's going to happen, but those type of risks I don't see slowing down anytime soon.
Chris, I saw some data this morning around rising unsold new construction inventories. I'm curious what you guys are seeing. I know you're surveying all the time the builder community, and it was kind of a spike, that we haven't seen since 2008.
Yeah, Tony, I saw some similar data. I think that's a really good point. And it speaks to that slide where we're talking about some of the builders selling off their unsold inventory end of month, end of quarter. Um, Honestly, I gotta think that's going to continue. Excuse me, I should say selling off that unsold inventory to SFR operators, and I think that will continue. The builders don't want to hold a ton of inventory on their books, especially with high mortgage rates, especially with kind of shifting demand on the for sale side of things. They want to move those homes, and so if they have a captive buyer in an SFR operator that'll buy 10 homes or 15 homes or 50 homes or whatever it is, I think you'll see that continue, especially where there's the most standing inventory, Southeast Florida, parts of Texas.
Yeah, it's going to be interesting to watch that trend. And just interesting the fact that truly build to rent product is built a little differently than built for sale product. So, it's one thing that we're really sensitive to as we look at opportunities is, what's the, I guess, Eric, you probably have better thoughts on this than I do, but what's the meaningful discount for build to sale product that's turning into rental inventory? I don't know the answer to that, but it's something we're thinking about a lot.
Yeah, I think that's a good point. And to make that switch so late in the game, oh, we're going to sell this, we're going to sell this. Wait, let's turn this into a rental. There are design components. There are pieces of the of the puzzle there that are a little bit different for sure.
Chris, I was going to jump in. Last question for me. One of the most fascinating slides, I think, was the one that you showed showing the $1,200 delta in Denver specifically between the cost to rent versus the cost to buy. And I'm curious, what's the long-term kind of equilibrium there, or where Denver and some other markets should be? Because that seems like that delta is just extremely high at the moment. And I'm curious if you could provide some context as to where that historically lands.
Yeah, and I'll actually go back to this map because you can see it kind of across the country in various forms. I think the long-term delta is probably in the $500 to $800 range. There will likely always be some premium, as there are benefits to home ownership for sure. Interestingly enough, you see some of the Midwestern markets where it's actually more affordable to own a home, and yet the rental side of things are still strong. I think that speaks to the overall lack of housing in general in those markets and the demand that's there. But the long term in Denver, same with Salt Lake, same with Phoenix. You look at parts of California, more than $2,000-3,000 delta. I think that's got to come down, and I think it will as there's more and more home building. As I mentioned, the home builders are still building more than the BTR developers and multifamily developers. So as supply shifts back towards that for sale home, single family for sale, I think you'll see these deltas come down a little bit. But again, as long as there's a four-figure delta in a market like Denver, that's on the average cost. If the average cost to own in Denver is somewhere between $3,000 and $4,000, that's a 25% delta right there. That's a meaningful chunk of people's income, meaningful chunk of change. So that's going to continue to push the BTR demand, and keep those rentals stable. But I think over time it will drift back probably to the $500 to $800 range, depending on the market.
Got it. That's helpful. Thanks for the context.
Do you think if it gets back to that level, that would impact build to rent demand are we overbuilding build to rent if that dynamic changes in some of these markets?
It may, but I think honestly, I could see that delta widening before it shrinks, especially because it is so challenging to purchase a home right now, and the BTR supply is slowing down so quickly. So that demand, that lack of supply and the continued elevated demand, truthfully, may push the delta up before it falls.
I mean, I could keep doing this all day, so I don't know that everybody wants to listen to a conversation between Eric, Brian, and Chris, but so I think we should wrap up. But guys, great stuff, great data. We'll make this deck available to those who attended, and the replay will be available as well. And Chris, I didn't realize you were here in Denver. We probably need to meet up for cocktails and keep talking about build to rent.
Absolutely. Absolutely. I'd love to, Tony.
Mr. Ferry, anything else we need to do to wrap up?
No, I think we're all set. So thanks everybody. And the chat is working, as you can see now. So glad we got that figured out. But thanks again, Chris. It's been awesome working with you behind the scenes, and looking forward to, doing another one of these hopefully in the future.
Sounds good. Thank you.
Thanks, everyone.